Hey coconuts, welcome back to our Tuesday's weekly market updates. I'm Rakesh,
And I'm Anthony.
and today we have 4 topics to talk to you about. First off, we're going to kick things off with Beyond Meats, a company that just went through Q3 earnings.
And after that, to continue in this trend of saving the world, we are going to talk about Shell and its non-pollution and restructuring.
Talking about saving the world, J&J is on topic this week with regards to some sort of split that they're having.
And finally, back to the real world where we talk about real products. So we're going to talk a bit in the local context about Riverstone and its Q3 earnings as well.
Real products. Okay.
No, we
Nice,
have we
Anthony.
have a tech light show. Let's talk about tech every single week.
That's true, actually. We do, I think every week we always talk about either Tesla, Apple, Netflix, or like Disney. So it's actually
And
and
Bitcoin.
Bitcoin, yes. So it's kind of invigorating to move away from it a little bit as well. All right. Why don't we
Yeah.
kick things off, right? So I was reading the news, Anthony, and Beyond Meats just had a Q3 earnings. Now, the good news
Wait.
of
So
yes.
Beyond Meats is Impossible, but another brand, right? It's just plant-based meats.
Yes. Okay. Good. Yeah. I think for coconuts out there and for our readers, listeners, sorry, readers. Beyond Meats is a sort of plant-based company. They create burgers and patties, rather. They're creating chicken, all these plant-based meats. They started off with the Beyond Meats burger patties, and now they're trying to move to chicken as well. Their competitor is Impossible. So I think we have heard of the Impossible Burger, right?
Yep. Yeah. So okay. So well, I see them around now. Their earnings have been great, right? I
They're
mean, we are in
sorry.
Singapore. We are in Singapore. We are far from the US, but we still see these products. I assume their earnings were fantastic.
Yes, yes. We do see these products. We see them in the NTUC as well. Don't forget, right? Their
Oh
revenue
wow,
did
even
see growth
NTUC.
though. Yeah, you can buy the frozen Beyond Meats burger patties.
Oh wow. Okay.
Yep,
Cool.
yep. Same with Impossible and so on and so forth. They are there, but it doesn't contribute to a lot of their revenue. Most of their revenue comes from restaurants and all of these things, right? Actually, if you go to like Over Easy and all these bars now actually have it. But yes, so their revenue growth is. Sorry, my mic dropped. The revenue growth is growing, right? So it grew actually 13% from last year. So it's now currently at 106 million, right, for Q3. So which is pretty good. Unfortunately, that's where all the that's where all the good news stops, right? We saw a drop in share price as soon as they announced Q3 earnings, right? And the main reason was because there was net loss of 54 million, which is actually 3 times Q3. So last year. So think about it this way, right? Revenue gained 13%, but their net loss was 3x what they had last year,
What did they do?
right? Yeah, exactly. What did they do? I think just before we jump into that though, and one other thing though that caused this share price to drop was the fact that the management has reduced their forecast for Q4 and for the next year. So they don't have a lot of expectation in terms of companies or growth, which
Mhm.
obviously allowed the share price to drop, right, by quite a fair bit. What exactly happened was that they invested in a lot of R&D. They started spending cash. They started to expand quickly without proper understanding of the market. Is what I'm thinking
Okay.
here, right? So let's put it this way: they they blew up in 2019, right? Them and
Yeah.
Impossible, together with other companies, right? It was like the thing. Hey, have you tried the new plant-based burger? I can't believe it's not meat, etc., etc. So they grew actually 219% in 2019. In 2020, they grew only 36%, right?
Okay.
And in 2021 now, where they're expected to grow something like 13 to 16%. But you can see it like a downward trend, right? And the
That's. I
forecast
mean,
is not looking great.
this is a growth company, right? It's not. It's an unsaturated market. They should be winning market share, and it's a huge TAM, and all of those junk that you growth investors believe in, right?
Yeah,
What's
yeah.
going on? Why is this so low?
Yeah, and it's a bit weird as well, right? It's also the fact that this whole plant-based thing, sustainability, has been popping up for the last few years, right, with EVs and stuff like this. And this is definitely the food alternatives with regards to methane from beef and all of that we do
Yeah.
get. So we do see that trend, and that trend is there, but their profits isn't actually somehow working out. And here's partly the reason why, right? They have had collabs with McDonald's, they've had collabs with KFC, and now they're also having collabs with Pizza Hut. Now, let me break this down for you. McDonald's, they launched a plant-based burger in Europe and in like 8 locations in the US. However,
Okay.
the beef is selling better in McDonald's than the plant-based burger when they tried it out at those locations,
Well, naturally,
right?
right? I mean,
I mean,
you don't go to McDonald's and go, I'm vegetarian today. I want McDonald's, but vegetarian. Come on.
yeah. Yes, so that's one. And to the point where McDonald's isn't actually scaling their business as well. They're like, you know what, we've got this. We may turn it down, but we'll see how it goes, right? So they still say like,
Okay.
hey, okay, we'll see how it goes. But
It's still
there
testing
hasn't
and they
been
haven't
much
rolled
from
it out.
testing. But I'm pretty sure McDonald's got their eyes set on something else. And with
Impossible.
KFC, yeah, so maybe impossible, maybe not, right? But with KFC, now good. One thing I want to note here is that when Beyond Meats first came out, they started off only with beef. So fake beef, in other words.
Mm,
Now they've sort of expanded to fake chicken. And so they've managed to get a collab with KFC to roll out their plant-based nuggets. All right.
okay.
So KFC, this was, I believe, in a few months ago, and they were testing it out. However, KFC mentioned that they are not going to make it nationwide. So this is in the US, right?
Yep.
It's only within a few locations and they're not expanding because they don't see the value, right? Of
Okay.
course,
So,
right? What Beyond Meats is saying is that, oh, it's still being tested. We'll see how it goes, but they're definitely going to scale,
yep.
right? Of course, with McDonald's there, with KFC there doesn't seem to be much uptake because people go to KFC for the chicken, maybe not, and not probably not for the plant-based meats, right? And same thing for McDonald's. This is what I'm thinking.
Yeah. I
What
completely
do you?
agree. I mean, if I'm vegetarian, I would not think about going to KFC for a meal. Seriously, right? Like, come on, what were they thinking? I mean, yes, maybe they wanted a volume-based business, right? Because if you could go with McDonald's or KFC nationwide in the US or even globally, that's huge market, right? And just
Mm.
even just taking 10% of their sales would be fantastic. But doesn't seem to be working out, unfortunately. So maybe it's time to move on. I guess I don't know. Is has management kind of given any indication on where they think they're going?
So, as far as I know and understand from KFC is that it's still in the testing phase. They will review it when it's the end of the testing phase, and then they'll decide. Right? This is what I read. But that said, they have one more collab, Pizza Hut, right? And this is about to
Okay.
launch, as far as I know, where they're going to put the fake meats on pizzas.
Yep.
And this one, I have no data whether it's working or not. So we'll have to wait and see, maybe for Q4 earnings call or Q1 next year. But from what I understand at McDonald's and KFC, it just doesn't make sense, right? Why are they targeting the fast food industry? Why are they targeting the gourmet industry?
Exactly. Right. I mean, they are they're probably putting their eggs in a basket, but the fast food basket, which is. I mean, I can't make sense of it. Hopefully management does, but it seems like I'm right and they are wrong. So too bad. And the market agrees with me.
Yes, so that's one, right? And also that said, what I'm thinking about as well, and this is my takeaway, right, for coconuts listening out there. Was it just a big hype that we saw in 2019? Was it just a big hype that we saw in 2020, right? Of course, Beyond Meats mentioned and started to blame the pandemic during the earnings call, right? Said like, oh, nobody's going to fast food, nobody's going to the restaurants, therefore we sold less burgers. Now, I don't think that's necessarily true because a lot of people have been either dining out or getting food taken in back to their homes, right? Here in Singapore, in the US, Europe, everywhere. And some restaurants actually reduced the capacity and opened up a cloud kitchen because guess what? It was more profitable. And they
Yep.
see this as the new norm. So if that was really the way that was going to be working out, the suppliers such as plant-based or in this case Beyond Meats would not be losing out at all. What I do know as well is that part of their losses was because of the increase of the soy and all the different stuff they use to make the patty.
Yeah,
Yeah.
that's any business, right? Everybody has that cost increases. yeah, I mean, look, I think management can give excuses all they want, but I think that takeaway is right. That there's just been a bit of a deflation in the hype, or rather, reality has come in, and that the hype just didn't measure up to the hype, right? I mean,
Mm.
the meat market is great. Maybe somebody will replace all of these with plant-based products one day because that's necessary for the environment, but at least on the current trajectory, it's not Beyond Meats that's going to be the winner here.
Yeah, I think so as well. And I don't know about the industry as well. Impossible Foods, by the way, its competitor also came up with a chicken thing, but fake chicken. But I really see this as a hype thing, right? It was a big hype, right? Oh, it's very cool, right? Temasek invested in all of them, etc., etc. Everyone's making money. But are there even better growths out there, right? Like okay, I hate to say it, but Tesla or EV, or last week we spoke about
Come
Rivian,
on.
right?
Oh, did you see the Ribbon share price is doubled? Dude, we
I
should have
know.
gotten on that.
Yes, we should have gone in.
To say, okay, yeah, but back to Beyond, it's terrible. It's beyond terrible. Let's just skip this.
Yeah, exactly. So, I mean, coconuts for you listening out there, do take a note of this. I honestly think there's better options out there. We have to see how this is going. I think it will be sustainable, but at a normal level, right?
Yeah.
And I don't see it as a big hype that it first was in like 2019, 2020.
Yeah, completely agree. And I think, this has really been a bit of a black mark against the management in terms of execution, right? They
Mm,
managed to get a high valuation, but they couldn't really execute against it. So unless they can show something to prove otherwise, I think maybe it's best to skip this for now, as compelling as the story might be.
fair enough.
All right, cool.
Well,
Then,
Anthony, what do you have for us?
yep, still on saving the world, but hopefully in a better way. Shell, right? So we spoke about Shell a few weeks back, and this activist investor, Third Point, took a big stake. They wanted to break them up. We poo-pooed
Mm,
it and said, this is terrible. Why are they doing this? Bad.
mm.
But I think obviously management agrees. So what they have done, or what they just announced last night, is actually to do a bit of a restructuring. So a bit of history in case you weren't paying attention in school, right? Shell is Anglo Dutch. They are like the equivalent. They were the equivalent of the British East India Company, which is why they are called Royal Dutch Shell, right? And they are based
Oh, I
in
didn't know
both.
that.
i- Yeah, see, history lesson, right? More than stocks.
Yeah, I did not pay
And
attention in history
yes.
class.
But yeah, back to the financial part, they are kind of removing their headquarters from the Hague in Holland to London. They are removing their tax residency from Holland to England. They are collapsing their share classes, which we can talk about a bit more later. But they're still maintaining their listing. So it's a corporate move essentially. They are not breaking up their business. It's really just to slightly simplify the corporate structure slightly, and hopefully unlock value, because that's always the reason for this sort of things.
Maybe if you could dive down a little bit, right? So why are they doing this? Unlock value. What do they mean by that?
Yeah, so I think, well, the Dutch part is history, right? So
Mm,
they actually have two share classes. So not only are they listed in London, they're listed in Amsterdam, they're listed in New York. They have, and in each of these they have different classes of shares. So they have A shares in Holland, and they have B
mm.
shares in London and New York. And the reason for this was really for tax efficiency, because Amsterdam had higher dividend withholding tax. So they had this whole convoluted structure of having a different share class, right, which would pay dividends into a different shell company. Shell company.
Right.
And then move it on to back to the shareholders to kind of tax equalize it and make everybody whole, right? But that also meant that they
Mm.
couldn't do as much share buybacks in London because that depends on trading volume. They couldn't. They just had their hand tight because of the share structure. And that's where I think the gist of this comes in. The Dutch thing is just it's nice, but the whole point is to collapse the share structure and kind of kill the Amsterdam listing, even though they keep it there, just so that it's simplified and they can do all the buybacks that they want, because with all the divestments, they have a lot of cash coming in that they'll need to return. So I think Shell is a dividend play here. or a
Got it.
buyback
Okay,
play, right? Yeah.
so if I can clarify, basically they had a very complex structure which involved a lot of administration to even handle passing money here or buying back shares from either London or Amsterdam.
Yeah.
And they would just
A
want to make
lion,
it
a
simpler.
lawyer's bad dream.
Right.
Yes.
So
I
in
saw
other
this, I was
words,
like,
what
oh,
is
this is exciting.
look at how much I can bill.
Yeah, exactly.
Okay, so clearly they're unlocking value by not paying lawyers. I think that's brilliant. Uh,
Well, I mean, the
so
lawyers
yeah.
will charge this one-time fee to unlock value, and yeah, but that's essentially it.
Oh no, fair enough. So then what we're saying here is that they're making this whole entire system that they currently have, which is a little convoluted because of um, history, right? And the fact that it's archaic, right? It was just there. So what they're doing now is like, okay, one shot, let's make it all clean, let's make it easy. That will allow us to either buy back all the shares when we need to, or in which case be a bit more manipulative in the market.
Yep,
Would you say that?
exactly.
Ah,
Yeah,
okay.
good
Okay, so
summary.
they're not. Oh, thanks, man. So they're not splitting up like part of the business here or part of the business there or whatever.
No, no, no. It's all trying to play around with the shareholding structure. It's nothing to do with the actual business. Which we talked about last time, and we said yeah, it's better probably
Doesn't
to
make
keep
sense.
the businesses as they are. Yeah.
Yeah, yeah. Okay, cool. So in this case, you mentioned it's a dividend play. So
Yep,
you
pretty
expect
much.
a lot of net profits and you expect dividends to grow as well with this company, Shell.
Um, I think well, I mean, in our part of the world, we like dividends, but I think in London and New York, they prefer share buybacks just because of tax, right? But yeah, I
Mm.
think look, what what they have been giving out in terms of buybacks and dividends is 2 billion a quarter, right? That's per calendar quarter. They are
Wow.
expecting just in the fourth quarter of this year, just from one transaction alone, 7 billion, right? Which 6 billion need to be returned to shareholders, right? So
Okay.
that's the amount of cash that they're spinning off with divestments and the ESG transition. Because let's face it, right? Wind, solar, they are very cheap, to build. Unlike they are projects in the millions and tens of millions. They are not unlike LNG projects, which are in the billions. So it's a lot easier, and I think they will be spinning off a lot of free cash flow that they can't really invest in because renewables don't take up as much cash. So they will have to go back to shareholders sooner or later. And I think that's where the real value is unlocked. As they
Got
divest,
it.
as they transition, that they will have to keep going back to shareholders, and this move is a way to make all their subsequent share buybacks a lot easier,
Got it.
and
Got it.
hopefully that
And
reflects in their multiple as well. So win-win.
yes. When do they expect this to be done? Over X number of years, I presume, or
uh Probably the
do we
next
know?
year or so.
1 year.
It's going to be getting moving tax residents and headquarters are is a difficult thing. Unilever did the same thing actually last year, and it took about 18 months, so
Got
probably
it.
about
So I
there.
expect about the same. Cool. Well, it's nice to hear a company moving to London as opposed to companies moving away from London for now.
Yeah, surprising, right? Brexit, and people go to London. Oh well. Well, but
Yeah,
the,
I
the
know.
Dutch have had a bad reputation recently, so yeah, not
Got it. Got it.
unsurprising.
Awesome, man. Thanks for that, Anthony. That was great news. Um, and I think my next topic is same but different. Right?
Different
It's
is
Johnson and
yeah.
Johnson, right? We're saving the world. They're doing restructuring, but it's restructuring in a different manner as well, right? And what J&J, Johnson and Johnson, is trying to do or will be doing is splitting the baby powder, which we all know is very very profitable, right? In terms of their margins, and on one side, and they're creating another company for pharma and medical devices. So effectively, they're splitting that up, whereas previously they were one holdings. And I think that's completely fair, right? I think it should be happening. It's been a little late. I think they should have done it last year when everybody was trying to consolidate, but maybe they were focused on the vaccine, right? And
Nah, they can do two things at once.
well, let's hope. And I think with regards to that I just see it as common sense, right? Splitting it up. Baby powder is in a completely different life cycle, product life cycle stage, by itself, right? With China or clearly wanting to buy a lot of those. Australia is a big one here. Oh, actually, Asia is massive, right? And the US as well in terms of their Johnson & Johnson baby powder. And medical devices and pharma with regards to COVID-19 vaccines or other vaccines that they're trying to create or other pharmaceuticals they're trying to create, which is high initial investment, high research amount, and then getting a effective perpetuity over time. What are your thoughts
Yeah.
on the split?
Yeah, I think. Well, I mean, it makes sense, right? You have, as you said, businesses that are fundamentally different, right? You have a high volume, low margin, consumer products business, and you have, and that's relatively easy. I mean, think about again Unilever, all your FMCG goods. It's so competitive. It's just marketing that wins the day, right? And on the other side, in their pharma and medical devices, they don't really do generics. They do their own research. They try to come up with groundbreaking stuff. All these take money.
Yeah.
And of course, if successful, all of these are super high growth. So, I mean, from that perspective, you no longer think about making the cash flows consistent from one to the other. You spin them off. You have separate entities, and you let them focus on what they do best. And if the pharma business dies because they can't create new products fast enough or get patents fast enough, then that's too bad, right? There's no
Yeah.
requirement for the consumer business to come in and save them and do all that sort of conglomerate stuff that they should do.
Yeah.
Um, yeah. So yeah, I think it's
Uh,
decent. It's decent.
Yeah, no, fair. But I mean, I'm sure they'll still have like, a central treasury and all of that to funnel money from one entity to the next, right?
Oh no, I think they're actually splitting off completely, right? Which is why this will take time. So
Ah,
so they will have a new company that holds all the consumer products and
whatsoever.
list that company or sell it to PE or whatever. So it will be completely separate functionally, right? Different
Got it.
management and all of that, which is
Nice. Okay.
job
That's
creation,
fair.
right? Very important.
And you were talking about, medical devices thing doesn't work, but it's also the same thing, right? Because with baby powder, there were a lot of suits going on. I don't think it was only J&J, but for other companies as well. And we don't want that to impact the medical devices or research or pharma side of things as well, right?
Yeah, definitely. But I mean, this is a bit of a sidestep. But J&J did something clever in a sense. So they were
Okay.
getting sued everywhere for baby powder, talcum powder, and possible asbestos, and they were losing the suit. So what they did was they said, oh, we have contingent liabilities of a few hundred million, all right, because U.S. lawsuits are insane damages. We put that all into a new company, and we declared that company bankrupt. And you're like, what?
Their
How?
lawyers got a big
But
payout.
yeah, I mean, look, fantastic lawyering, fantastic thinking and structuring, but yeah, come on, man. So look, but they obviously know what they're doing in terms of corporate structuring and splitting off what they want. So I think this will be a decent move in the long run. I'm just not very keen on owning an FMCG business, nor am I very keen on having a pharma business in my portfolio.
Mm,
So yeah, for that reason, this is theoretical. It's nice. It's interesting. I'm not going to buy any of these shares.
no, that's fair. But we are noticing a trend as well, right, Anthony? Like, I mean, we talked about Shell, just next topic now, J&J. We also heard about GE, Toshiba. Why do you think they're all looking at splitting up and sort of divesting or creating the segment?
Wow. Oh, that I mean, okay, this is really new. I was there was this article in the Financial Times today actually, that said, oh yeah, this is really just a reflection of what universities are teaching. Right?
Okay.
So in the previous generation, so in the 60s and 70s, where Jack Welch and whoever were bringing GE up, the primary mode of thinking was that you want conglomerates, you want big um negatively correlated businesses, so that if one is in a down cycle, the other is in the up, and you make
Upcycle.
consistent profits throughout, right? Recently, at least in the last 10, 20 years, at least when we went to uni, they never taught us that, right? They said
No.
no, every company needs to have a
Specialize.
specialization. We'll let the market
Yes.
decide. If you fail, you fail, so you don't. Right? And I think that's kind of been reflected, and I mean, our generation is not in the boardroom yet, but I think for the people 10, 20 years older than us are, and the fund managers are. So I think there's a, and this kind of makes sense to me, right? There is that trend going on that goes, oh yeah, this is what we learned as the technically best way to run a business. Let's just do it this way. Who knows?
Fair enough.
But
So
this sounds
basically,
logically interesting.
yeah. So basically, whatever we learned in school is now being applied lah, when people are
It will
rising
be
up to
applied
the
20
right
years
level.
later, right?
Yeah. Correct. When you get up to the level that you can make these decisions.
Yeah. And I mean, thinking about it again, another step further, you think about your Blackstones, your KKRs. They are private equity, yes, but they also hold so many companies, right? They're essentially a
Mm,
conglomerate as well, functionally, just that they don't use one to offset the other, right? So
mm.
I think it's just a shift in thinking where people used to think that one company's management could do it all, and now it can't, and it's more efficient and better value to break them up, which is why I would, as a shareholder of Facebook, sorry, Meta, I would like them to break
Meta.
up Facebook and WhatsApp and Instagram as well.
Maybe they will, Maybe they will.
I wouldn't mind, honestly, but yes, topic for another day. Right? We just need to talk about
Speculation
Meta
for
and
another
Tesla
day.
and Apple every episode.
Man, I think we need to spin off, because every week there's so much news coming from them.
Yeah.
Okay, but back onto I think our last topic for today, Anthony. Back to reality. You mentioned.
Well, I mean, we have been very non-techy today, but we are
Mm,
moving, further into consumer devices, and we are going to talk about Riverstone, which is a glove company, right? So from baby powder and soap and shampoo, we have moved to gloves, which is fantastic.
sorry, I'm just going to clarify. Gloves as in winter gloves, or glove as in
Well, they do two types of gloves. They
operating
do
room gloves?
surgical gloves, right? Which
Okay.
obviously with the pandemic, huge demand. And they also do clean room gloves. So those are required for your semiconductor manufacturing, your electronics plants,
Ah,
that sort of thing. So very, very on topic, right? Just that they do gloves, which is unsexy.
yeah. We barely even talk about anything other than tech, let alone gloves. I mean,
Hey, without these gloves, you wouldn't have, your semiconductors, and then you wouldn't have
true.
tech. So it all works, man.
That's
It's
true.
all part of the same chain.
Fine. Tell us about this. Tell us about this company, Riverstone.
Yeah. Well, so obviously they do gloves, and well, you know what's going on in the last year or so, right?
What's happening?
Lots more I mean, in case you don't know, there's this thing called COVID, right? And
Ah,
lots more medical devices and a lot more concern about safety and all that. So
of
gloves
course.
were
Yeah, yeah.
naturally what people thought of. And they showed in the market, right? So they started
Mm,
in 2020, I think at 50 cents, Singapore cents. They hit 225, so they quadrupled, third quarter last year, which is fantastic given that everybody thinks the Singapore market is crap.
quadruple.
And
So two
now,
dollars twenty
well,
five cents lah.
yeah, so they have
Okay.
times four, right? Essentially, it's
Yeah.
a four bagger.
Yeah.
If you went from bottom, well, pre-COVID to peak, and now they are back at what 79 cents today. So back
Hmm.
down as well. Yeah, the Singapore market has volatility too. But what I thought was really interesting, right, is that this seems to be setting up to be more than a COVID play, right? So
Okay.
they just released their latest financials. It was decent. It was 30% up, 38% up year on year, but it's not growing anymore. So because of the glove market, right? It's just not doing well. Lots of surgical gloves are coming onto the market. They they are
Mm.
they are their net profit year to year was at 30-40% up, but their quarter to quarter was 50% down, right? So
Down.
not great, down, right?
Right.
So which just shows you how much they pulled forward, net profit in the last two quarters. It was insane, right? And
Absolutely.
to give more tangible numbers, it was what 260 million in terms of profit. This is ringgit, I think. Last quarter, pre-COVID,
Hmm.
the profit for the entire year was 130 million. So you have essentially 8 times your profit in 2 years,
1 year.
right?
Yeah.
Yeah, maybe the market structure is bad. Maybe it's going to go down again. But I mean, think about it, right? If even if it goes down by another 50%, which is unlikely, your net profit just in a quarter hits 130 million. That was what they were
Mm.
making in a year 2 years ago for an entire year. It's great. They have had it's essentially moved them to a new steady state, but I don't think that's reflected in the market.
Got it.
But yeah, do you does this make sense to you? Like I don't know,
Yeah.
right? I'm an old school guy. I like looking at PE ratios, which is 5.6 by the way. It's low. I don't think we have seen PE as low in any of our stocks in the
No.
show before, but
I stopped
yeah.
looking at PE a long time ago, my man.
No, I don't think we even have PS at 6 times, right? From beyond, it's probably like 20 or 50 or 100. So yeah, it's amazing. I think, right? But the
Mm,
market just doesn't seem to recognize it. So I think something for coconuts to look at in a bit more detail.
definitely. And a quick question for you. Okay. So just to clarify, this company, Riverstone, is listed in the SGX,
Yes,
but they are
with
a
factories in
Malaysian
Malaysia.
company.
Yes.
So with factories in Malaysia, but they're a Singaporean company.
Well, yeah, I mean, they have a
Technically,
they
lah.
have a company in Singapore, they have a company in KL.
Yeah.
Yeah, but they are essentially, yeah, they're a Malaysian company.
Got it. Okay. So my question for you is, I mean, and your question to me was, why is it not like, is it a good buy? Right.
Yeah.
Given that
Oh,
it's
I think it could be a
reflect.
good buy. Tell
Mm.
me why not.
But you mentioned their quarter on quarter has been dropping
Yep.
50%, was it? So
Yes.
where do you see the next quarter? Right. I guess that's my question, right? So now we've seen it grow and we've seen it drop. Right. Hit $2, and you mentioned it dropped to 75 cents.
Yeah.
And pre-COVID, it was 50 cents. Is that right?
Yes.
So what makes you think that it will go from 79 cents that you said up as opposed to back to 50 cents? Because the surgical gloves industry, number one, is becoming more saturated with, China obviously shipping it out and multiple other companies catching up to that technology.
Yep.
And with the COVID effectively moving to an endemic state, are we going to see an increase on these gloves? That's my question to you.
Yeah.
Do you think that will increase?
No, so exactly right. I don't think it will increase. Actually, I think it will decrease. And
Mm,
the projected decrease in I actually read this. I can't believe it. The projected decrease in the surgical glove market on a per unit basis is going to be it's projected about 20% less in 2022, and probably
okay.
about 35% less in
So why would I
2023.
buy?
No, but that's exactly the point, right? Even if you took a 50% discount of net profit, and surgical gloves is only what 50% of their product mix and their revenue. So we take a much bigger haircut, right? We say that not only could surgical gloves fail, clean room gloves, which is actually succeeding and they are the market leader in globally, right, also fail and it's 50% decrease. They still make, compared to pre-COVID times, 4 times net profit, right?
Hmm.
Yearly, right? And this is stable. Even if it doesn't grow forever, it's still stable. So there is no reason, even if we compress the multiple, whatever, 2023 onwards, stable basis, it's the same price or just 40% more than the pre-COVID price, right? There is quite a fundamental, I think, mispricing here.
Fair enough. So what you're saying here is, unlike the rest of the stocks that we've been talking about,
This is
with
cheap. We should
Tesla
buy.
and Rivian
Not
and all
financial
of
advice, by the
them,
way.
it's not. Yeah.
Yeah.
So what you're saying is, comparing to those, this company actually has fundamentals, actually has a growth in its net profit, and we expect that even at a 50% haircut. But the price or the market sentiment isn't quite there.
Yep. But
Right.
but nobody's projecting more than a 50%. Nobody's projecting even a 50% haircut, right? So your debt
Of course.
assumption is much more conservative than any other analyst in the market, but you're still making money, right? And
Yeah.
oh, sorry, one last point. So they had bumper quarters, right? The last two quarters. They
Of
actually
course. Yeah.
announced in the last earnings that they, if everything goes to plan, they would project actually a 20-cent dividend for financial year 2021. So you get,
Dividend
you
play.
you buy 80 cents now. okay, 6 cents is
It's
over. Sorry, 8 cents it was declared earlier this year, but you get 12 cents back. Risk free end of the year, and yeah, that's an immediate 16% return for nothing much, right? So
Hmm.
even if they take the entire 2 COVID years as an anomaly, they are returning all spare cash after investments because they're expanding as well, but they're returning all spare cash to shareholders to do what you want with. So I don't see a downside. You know, I think
Oh, fair
the
enough.
if it's fundamentally mispriced, nobody wants to look at it. So be it. You are going to get 16% dividend return this year in the next 4 months. You are going to get 8 to 10% dividends going forward because that's how profitable they are. Oh, you recover it in 5 years,
It's
right? So yeah, it's
absolutely.
not a bad company at all.
Fair enough. And in all fairness, when they create the gloves for semiconductors, as we know, is going through a shortage, and we're seeing expansion in terms of infrastructure. So there could be a demand for their gloves. And you mentioned they're
Yep.
also a global leader in that, right? So
Yeah, I
we
mean,
could
you build
definitely
more
see.
foundries, you need more gloves, right?
Absolutely. So that definitely could be that angle. And I think as they raise their dividends, so on and so forth, this could be a very good play, especially for Singapore market where it's quite dividend heavy. Right. I think,
Yep.
for our coconuts out there listening, please let us know on Telegram, on Twitch, on Facebook. If you want us to do a stock geek out on this, we can get Reggie right on it, right? who can do some sort of analysis and tell you, yes, this is the fundamentals, this is what's exactly happening. So if you do want us to go ahead deeper into this, please let us know. We're more than happy to do that for you. You can message us on Telegram if you haven't joined our group, or message us at hello@thefinancialcoconut.com. Awesome, Anthony. I think that was a really good find. Very rare do you
Yeah.
find companies that
Sorry,
that are
I've been averaging
fundamentally
down
good.
for a while, so
All
I'm very
right.
upset that it's mispriced.
Well, technically you should be happy, right? Because then you can go in and get all your dividends and at a lower
Well, no,
price, and
I've
if
been
demand
buying for a while,
increases.
right? So I'm just waiting for them to reprice
Wait,
properly.
okay. Hopefully it will go back up to when you first purchased. Are you
Yeah,
averaging down?
or
You just
even
keep going.
20%
You should be
more.
fine,
I'll be quite good. Yeah.
right? Fair enough. Yeah, I mean, I think that comes to the end of our show. So thank you so much, Anthony, for of course taking the time, and coconuts for listening in. We will see you next week. Bye.
All right. See you. Bye.